Usually when we talk about a medical diagnosis, there is this expectation of precision. You know, you break your arm, the x-ray shows a jagged white line and the doctor points at it.
Right, it's broken or it's not broken.
Exactly. It's clean, it's visible, and it's categorized. But step into the world of psychiatry and neurodevelopment, and suddenly that x-ray machine is, well, it's totally useless.
Yeah, you enter this diagnostic landscape that's entirely murky. It relies on subjective feedback, trial and error, and just complex chemistry that we honestly barely understand.
And that same dynamic, that shift from clean binary x-rays to murky, complex realities, that applies perfectly to Wall Street earnings calls.
Oh, absolutely. Everyone wants the financial x-ray.
They do. They want the clean beat or the clean miss, up or down, good or bad. But welcome to Talk Tickers, the deep dive where we break down corporate earnings calls for retail investors like you.
And we are very data forward here. We translate the Wall Street jargon into plain language. We're opinionated, and most importantly, we want to give you something actionable.
Actionable, right. What does this mean for someone holding or considering the stock? And today, our mission is to look at Aytu BioPharma, ticker symbol AYTU, specifically their fiscal Q2 2026 earnings.
Yeah, and we're going to use our standard Talk Tickers format. We'll hit the headline numbers, the story behind those numbers, management guidance, and finally the bottom line. Is this a bullish or bearish signal?
So let's jump right into part one, the headline numbers. And I got to say, if you were looking for a clean financial x-ray here, you're going to get whiplash.
Definitely. You look at the headline numbers for the period ending December 31st, 2025, and, well, they went from reporting net income of $800,000 a year ago to a net loss of $10.8 million this quarter.
Right. So a retail investor scraping the headlines sees a $10 million swing into the red. And naturally, you assume the company's core business is just collapsing.
But that surface level metric is basically that broken x-ray we were just talking about. It obscures a massive, highly calculated business pivot.
Yeah. Aytu is intentionally sinking some short-term metrics to bet the house on the commercial launch of a new depression drug called Exua.
So to figure out if this stock is a buy, a hold, or a fold, we have to pull apart the raw data. Let's look at the top line first. Net revenue came in at $15.2 million for the quarter.
Which is down, right?
It is. Down $1 million from the $16.2 million reported in the prior year.
Okay, so slight dip. But breaking down the composition of that $15.2 million reveals the internal shift, right? Let's talk about the ADHD portfolio.
Yeah, their historical cash cow. It brought in $13.2 million. That represents a flat sequential quarter from their fiscal Q1 and just a really slight dip from the $13.8 million they did year over year.
Right. And then there's the pediatric portfolio,
which brought in $1.7 million. That's a nice sequential uptick from $715,000 in Q1, but, still down significantly from the $2.7 million we saw in the same quarter last year.
And that pediatric drop, that's a perfect example of Aytu actively clearing the decks. Aytu's CEO, Josh Disbrow, he indicated they are purposefully de-emphasizing marketing for those legacy products.
Yeah, they are. And a major factor there involves recent regulatory noise from the FDA and the broader administration regarding fluoride.
Because Aytu's pediatric line includes fluoride-based vitamins, right?
Exactly. The regulatory landscape around fluoride in supplements and pediatric vitamins has become increasingly, fraught?
Fraud is a good word for it.
The FDA has been tightening its scrutiny, demanding more rigorous clinical validation for long-standing products, and simultaneously, certain advocacy groups have been pushing these PR campaigns questioning systemic fluoride supplementation.
Which, we're not taking a stance on the politics or the science of the fluoride debate here.
No, not at all. But from a purely operational standpoint, for a small-cap biotech company engaging in a protracted regulatory battle or some massive consumer education campaign over a legacy vitamin product, that's just a massive drain on capital.
And focus. You look at the board, you see an uphill regulatory battle over vitamins, and you make the operational choice to basically reallocate those marketing dollars.
Right. It's a calculated retreat, so they can focus on higher margin proprietary therapeutics.
Speaking of margins, we got to address the gross margin for the quarter. It dropped to 63.5% from 66.5% the prior year.
Yeah, a 300 basis point drop looks pretty bad on the surface.
Yeah.
But Aytu's CFO, Ryan Selhorn, he detailed a highly specific accounting event driving that decline.
The write-down, right?
Exactly. A $600,000 inventory write-down related to their branded ADHD drug, Adzenys.
And that write-down is a direct consequence of Aytu launching their own authorized generic version of Adzenys.
Which is such an interesting move.
Yeah.
When a pharmaceutical company launches an authorized generic, they are essentially taking the exact same branded formulation manufactured in the exact same facility and just slapping a generic label on it.
Why do they do that?
To capture patients who are being forced by their insurance to step down to generic pricing tiers.
Okay. But doing that creates friction in the physical supply chain, I'd imagine.
A ton of friction. You have to forecast how many patients will stay on the premium brand and how many will transition to your new authorized generic.
Right. And if the shift happens faster than you thought, you end up with all this excess, short-dated, branded inventory just sitting in warehouses.
And pharmaceutical products expire. So that $600,000 write-down was basically Aytu truing up their balance sheet to account for branded Adzenys inventory that aged out during that transition.
So it's a one-time hit.
Exactly. If you back out that one-time write-down, the adjusted gross margin sits at 67.4%.
Oh, wow. So the underlying margin profile of the products actually improved over the prior year's 66.5%.
It did. The operational efficiency of the business is strengthening, but it's completely masked by a temporary supply chain adjustment.
Okay, that brings us to the murkiest water of all. The headline number that probably gave retail investors a heart attack, the $10.8 million net loss.
Yeah, $1.05 net loss per share. It's brutal on paper.
To understand the actual health of Aytu, you have to realize that $8.2 million of that $10.8 million loss was a non-cash derivative warrant liability loss.
Yeah, we need to dig deep into this because this is where Wall Street accounting detaches completely from common sense.
Let's unpack this because it centers on how the SEC and the Financial Accounting Standards Board treat specific types of stock warrants, right?
Right. A warrant gives an investor the right to buy stock at a predetermined strike price in the future. But because of the specific anti-dilution clauses and the structural mechanisms within Aytu's warrants, accounting rules dictate they cannot be classified simply as equity.
So what are they classified as?
They must be treated as a liability on the balance sheet until the investor actually exercises them and converts them into common shares.
A liability that fluctuates in size based on the current market price of the stock.
Exactly. CFO Ryan Selhorn laid out the paradox perfectly on the call. If Aytu's stock price goes up, the company incurs a loss. If the stock price goes down, the company incurs a gain.
Okay, hold on. This Wall Street quirk is it's mind-bending. Let me try to use a real estate analogy here so the listeners can visualize this.
Go for it.
Imagine you own a house and you sign a contract giving a buyer the right to purchase it next year for $300,000.
Okay, tracking.
Suddenly, a massive tech company builds a headquarters down the street, and your house is appraised at $500,000. In the real world, your asset appreciated. You're happy.
Right, you have a more valuable house.
But under this derivative accounting rule, because you are contractually obligated to sell it for $300,000, the accountants look at that $200,000 increase in value and they penalize you for it.
Yeah, they say your obligation to the buyer is now heavier.
Exactly. So they record a $200,000 loss against your income. You lose money on paper purely because your asset became more valuable.
That captures the absurdity of the Black-Scholes pricing model perfectly. Aytu performed well enough that its stock price rose in the open market. The intrinsic value of the right to buy that stock at a fixed lower strike price increased.
And since those warrants are sitting on the books as a liability?
An increase in the warrant's value means the liability mathematically grew, triggering an $8.2 million non-cash charge.
It's just wild. Last year, the stock price was down, the liability shrank, and they recorded a $3 million paper gain.
It's all paper. The critical takeaway for you, the retail investor listening right now, is that you must strip out that $8.2 million phantom loss to understand the actual operational cash burn of the business.
So let's do the real math. Stripping out depreciation, stock comp, amortization, and this massive warrant liability, what are we looking at?
Aytu's cash operating expenses were around $10.8 million for the quarter. They ended December with $30 million in cash and cash equivalents.
Down only slightly from $32.6 million at the end of September?
Right. Burning $2.6 million in cash in a single quarter while actively launching a major new pharmaceutical asset requires, frankly, ruthless capital discipline.
It does. And to evaluate their market cap, we have to understand the total share count, because that derivative liability ties directly to the number of shares potentially hitting the market.
Right. So during the quarter, 550,000 pre-funded warrants were exercised, adding about 1.3 million to additional paid-in capital.
So where does the share count stand as of the earnings call?
Aytu has 10.7 million common shares outstanding, alongside 8.8 million pre-funded warrants.
Those pre-funded warrants are a crucial mechanism for retail investors to grasp when looking at small-cap biotech. Why do they even exist?
Well, when Aytu acquired Exua, they brought on institutional capital. Those institutions often have strict charter rules, or they face really heavy SEC regulatory filings if they own more than 9.99% of a company's voting common stock.
To avoid triggering insider reporting requirements, right, under Section 16.
Exactly. The 9.99% ownership blocker is total standard practice. So to bypass this, Aytu issues the institution common shares right up to that limit. For the remainder of their investment, Aytu issues pre-funded warrants.
The investor pays for the shares up front, hence pre-funded.
Right, usually leaving a nominal fraction of a penny as the exercise price. They effectively own the economic value of the shares without holding the voting rights,
keeping them safely under the regulatory threshold. So to calculate Aytu's true market capitalization, you combine the 10.7 million common shares and the 8.8 million pre-funded warrants,
creating an effective share count of 19.5 million.
So, summarizing Section 1, the baseline financial reality of Aytu in Q2 is a slight managed revenue dip to 15.2 million, underlying margin expansion to 67.4%, a secure $30 million cash runway, and a totally misleading paper loss.
Exactly. Which transitions us perfectly into Section 2, the story behind the numbers. What drove these results?
The pivot.
The pivot. The deliberate reduction in legacy revenue sets the stage for Aytu essentially winding down their defensive operations to go fully on the offensive with Exua.
Let's do a deep dive into Exua, because this is the catalyst for everything. Exua is the first and only 5-HT1A agonist approved by the FDA for the treatment of major depressive disorder, or MDD, in adults.
And you have to ask, why is a tiny company betting its entire existence on this molecule in a market that is already flooded with dozens of generic antidepressants?
To answer that, we have to look at the severe limitations of the current standard of care.
Right. Aytu actually highlighted Dr. Stephen Stahl, who is a globally recognized psychopharmacologist, during their investor day to explain this dynamic.
What did he say?
He pointed out that the current frontline treatments for MDD are SSRIs, selective serotonin reuptake inhibitors, and SNRIs. Drugs you've heard of, like Prozac, Lexapro, Zoloft.
But the biological mechanism of an SSRI is surprisingly, well, brute force. I'll try to break it down simply.
Yeah, please do.
Neurons communicate across this microscopic gap called the synaptic cleft. The sending neuron releases serotonin into the gap, it binds to receptors on the receiving neuron, and then the sending neuron reabsorbs the leftover serotonin to sort of clean up the gap.
The reuptake process.
Exactly. And SSRI blocks that reuptake process. It traps serotonin in the synaptic cleft, forcing it to pool and accumulate, hoping that higher ambient levels of serotonin will just generally improve the patient's mood.
But the fundamental flaw in that approach is a profound lack of selectivity. The human brain contains at least 14 different known serotonin receptor subtypes.
14.
Yeah. By indiscriminately flooding the synaptic cleft with serotonin, an SSRI activates all of them. It activates the 5-HT1A receptor, which regulates mood and anxiety, which is what you want. But it also activates the 5-HT2A and 5-HT2C receptors, and those are linked to sexual function, appetite regulation, and sleep architecture.
It's the equivalent of trying to water a single dying tomato plant by turning on a fire hose that floods your entire backyard.
That's a great analogy.
The tomato plant gets water, sure, but you destroy the patio, you drown the roses, and you flood the basement in the process. Those flooded areas represent the off-target side effects.
Severe insomnia, anxiety, weight gain, and treatment-emergent sexual dysfunction.
So how is Exua different?
Exua abandons the fire hose model entirely. It is not an SSRI. It does not block the reuptake of serotonin. Instead, it's a highly targeted molecule designed to physically engage only the 5-HT1A receptor.
The transcript explicitly defines its mechanism. It acts as a full agonist at presynaptic 5-HT1A autoreceptors and as a selective partial agonist at postsynaptic 5-HT1A receptors.
Okay, let's break down presynaptic versus postsynaptic, because the real elegance of the molecule is right there.
The presynaptic neuron is the one sending the signal, right?
Yeah, right. And the autoreceptors on that presynaptic neuron act like a biological thermostat. When serotonin levels get too high, those autoreceptors trigger a negative feedback loop.
Shutting down further serotonin production.
Exactly. By acting as a full agonist at the presynaptic site, Exua essentially hacks the thermostat. It fine-tunes the brain's natural serotonergic signaling without trapping excess serotonin in the gap.
Wow. And simultaneously, it crosses the gap and acts as a partial agonist on the receiving postsynaptic neuron.
Right. A partial agonist binds to the receptor, but only activates it to a fraction of its maximum capacity.
So if the natural serotonin signal is too weak, Exua boosts it. But if the signal is hyperactive, Exua competes for the receptor space and dampens it down.
Exactly. It stabilizes the specific mood-regulating circuit without spilling over onto those 5-HT2 receptors that control libido and metabolism.
And the clinical results of that precision are staggering. Dr. Anita Clayton, a principal investigator for nearly every new antidepressant approved since 1991, laid out the stakes for the MDD market.
We are looking at a total addressable market, or TAM, of 21 million U.S. adults.
21 million. And nearly 15 million of them experience severe functional impairment.
And despite the widespread availability of SSRIs, 50 to 60% of patients fail to achieve remission on their first-line therapy.
Drugs simply do not work for more than half the population.
But more alarming is the discontinuation rate. Nearly half of all patients prescribed a traditional antidepressant quit taking it entirely, largely driven by tolerability issues.
Which makes sense. I mean, if a patient is suffering from clinical depression and their medication causes them to gain 40 pounds and completely lose the ability to experience sexual intimacy.
The secondary psychological trauma often outweighs the primary benefit of the drug, so they abandon the therapy.
But Exua disrupts this cycle completely. It carries no FDA warning for sexual dysfunction. Across its phase 3 pivotal trials, it demonstrated a neutral sexual profile, with adverse event rates matching the placebo group.
And the weight gain profile is equally pristine. Exua showed no clinically meaningful weight gain compared to placebo.
Dr. Christoph Carell, one of the most cited scientists in global psychiatry, emphasized this. Combining meaningful antidepressant efficacy with this specific, unblemished safety profile is basically the holy grail of MDD treatment.
So Aytu has a molecule that solves the two primary reasons 10 million Americans quit taking their depression medication.
But pivoting the entire company toward Exua requires pulling resources away from their $13.2 million ADHD portfolio, drugs like Adzenys and Cotempla.
Right. And abandoning a cash cow to fund a new launch is usually a death sentence for a small-cap biotech, especially considering the ADHD market is currently under massive external assault.
Yeah, let's talk about that assault. In mid-December, Teva Pharmaceuticals, one of the largest generic drug manufacturers on the planet, launched an abbreviated new drug application, or ADA.
They introduced a direct generic competitor to Aytu's branded Adzenys.
And the launch of an ADA usually triggers an immediate vertical cliff for the branded drugs revenue.
Right. Oh, yeah. Insurance companies mandate generic substitution at the pharmacy counter. The branded drug loses 80 to 90% of its market share within a matter of months.
Because Teva has vast distribution networks and massive leverage over pharmacy chains to force their generic onto the shelves.
But Aytu anticipated the Teva launch, and they executed a brilliant, multi-layered defensive strategy.
The first layer was launching their own authorized generic just ahead of Teva, which we talked about, cannibalizing their own brand to capture the step-down patients.
But the authorized generic alone isn't enough to fend off Teva. Teva can undercut on price or offer massive rebates to distributors.
So what's the real firewall protecting Aytu's market share?
Their proprietary distribution network, RxConnect.
Oh man, this is where it gets really interesting. CEO Josh Disbrow shared the 6-week data following the Teva generic launch.
The Teva generic captured a dismal 5% of total prescriptions written for the molecule.
5%. Well, Aytu's authorized generic captured nearly 20%, and the remaining 75% stayed on Aytu's premium branded Adzenys.
A microcap biotech effectively walled off a generic behemoth, retaining 95% of the total prescription volume.
That defies every standard model of pharmaceutical generic erosion. How did they pull it off?
The mechanics of RxConnect explain it perfectly. RxConnect is a network of hundreds of independent regional pharmacies across the country that partner directly with Aytu.
And currently, 85% of Aytu's branded ADHD prescriptions are routed through this specific network, entirely bypassing massive chains like CVS or Walgreens.
The distinction between an independent pharmacy in the RxConnect network and a massive retail chain involves the role of pharmacy benefit managers, or PBMs.
PBMs, the middlemen everybody loves to hate.
Right. They negotiate drug prices between insurance companies, manufacturers, and pharmacies. When a patient takes a branded prescription to a standard retail pharmacy, the pharmacist processes the claim through the PBM.
And the PBM software often triggers an immediate prior authorization requirement, demanding the doctor fill out extensive paperwork proving the patient needs the brand over a generic.
Or the PBM applies a massive non-formulary copay, hitting the patient with, like, a $300 bill.
That friction at the counter destroys prescription fulfillment. The patient leaves without the drug, the doctor gets frustrated by the administrative burden, and they just switch the patient to whatever generic the PBM dictates.
But RxConnect physically and digitally circumvents that choke point. Aytu negotiates directly with the independent pharmacies in the network.
They establish predictable coverage parameters and guarantee a maximum out-of-pocket price for the patient, absorbing the back-end costs themselves.
So when the doctor sends the script to an RxConnect pharmacy, the pharmacist runs it, the price is guaranteed, and the patient walks out with medication.
Because 85% of Aytu's ADHD patients were already insulated inside this high-retention, low-friction network, Teva's generic couldn't even touch them.
Teva dumped their generic into the standard retail supply chain. But Aytu's patients weren't shopping at standard retail pharmacies. They were already captured.
This logistical moat allows Aytu's ADHD portfolio to run essentially on autopilot. The revenue base is protected structurally rather than through active sales detailing.
And this is what gave management the confidence to pull their sales force off the ADHD drugs and redirect 100% of their commercial firepower toward the Exua launch.
Which brings us to the cost efficiency of the launch transition. During the Investor Day, management revealed they originally budgeted $10 million for the Exua commercial launch.
But Ryan Selhorn noted on the earnings call that they slashed that budget down to under $8 million.
Slashing a launch budget by 20% at the 11th hour? Usually that signals cash panic.
It does. But Selhorn detailed that the savings came from internal execution efficiencies and tighter vendor management.
They brought certain marketing functions in-house and optimized their digital targeting, hitting their commercial readiness metrics without burning the extra $2 million.
Furthermore, $3 million of that $8 million budget is allocated to one-time infrastructural costs.
Like initial sales training, foundational marketing materials, consultant fees.
Exactly. Meaning their ongoing OpEx drops significantly once the launch stabilizes.
Which perfectly sets up Section 3, management guidance. What did they say about the future?
Aytu is managing investor expectations around a highly specific, short-term financial dynamic that we can define as the scripts before revenue phenomenon.
Scripts before revenue. Management explicitly warned the market that the March 2026 quarter of the period reflecting the initial months of the XY launch will show very light net revenue growth, regardless of how many actual prescriptions are written.
The disconnect between high prescription volume and low revenue ties directly to their strategy for breaking into the crowded MDD market.
Because Exua is a novel molecule. Doctors are intrigued by the lack of sexual dysfunction and weight gain, but they need clinical experience with the drug before adopting it as a frontline treatment.
So to eliminate every possible barrier to trial, Aytu is giving away 14-day titration packs to physicians at absolutely no cost.
Which is standard protocol, giving out samples.
True, physical samples are standard. But Aytu is leveraging the RxConnect platform to subsidize the first 2 full months of therapy for commercially insured patients.
The guarantee states that for month 1 and month 2 of the Exua prescription, the patient's out-of-pocket cost is capped at $50 maximum.
Regardless of the PBM's coverage decision.
Right. So if a patient's insurance denies coverage entirely or applies a $500 high-deductible copay, Aytu steps in through the RxConnect pharmacy and covers the spread.
The patient pays $50. Aytu eats the manufacturing cost, the distribution cost, and the margin loss.
It's a freemium user acquisition model, like a software company. You give away the product to build the habit and prove the efficacy, knowing you will monetize the user later.
Exactly. In psychiatry, dose optimization takes time. A patient might not feel the full clinical benefit of a 5-HT1A agonist until week 6 or week 8.
By guaranteeing access for the first 2 months, Aytu ensures the patient doesn't abandon the drug prematurely due to a surprise pharmacy bill.
It allows the physician to evaluate Exua strictly on its clinical merits.
But the financial consequence of this freemium model is that top-line revenue for January, February, and March is artificially suppressed.
The patient is getting the drug, the doctor is seeing the results, but the cash isn't hitting Aytu's income statement.
Selhorn explicitly modeled this out. He stated that meaningful net revenues won't be recognized until the month 3 refills occur and the no-cost guarantees burn off.
The revenue inflection point is pushed back to the June 2026 quarter.
But the early launch metrics suggest the demand is there even if the cash isn't yet. Disbrow noted that Exua prescriptions have been written in 27 states within the first 30 days of commercial availability.
And that geographic spread is vital. Disbrow confirmed they are seeing organic script generation in states where they don't even have active sales representatives on the ground.
Wow. That indicates physicians are actively researching the MOA and seeking the drug out independently for their treatment-resistant patients.
Over 100 doctors wrote a prescription for Exua in that first 30-day window.
Achieving that level of initial penetration is impressive on its own, but you have to factor in the catastrophic weather conditions during the launch.
Oh, the snowmageddon.
Yes. They launched Exua into the teeth of an historic winter storm system. Their national launch meeting concluded the second week of January, immediately followed by the MLK holiday week.
Which is traditionally a slow period for pharmaceutical detailing anyway.
And then back-to-back blizzards paralyzed the country. Disbrow stated that every sales territory outside of California was severely affected.
Sales reps were physically unable to travel to clinics. Doctors' offices were closed. Logistical hubs shut down, delaying physical sample shipments to the RxConnect pharmacies.
Half of their available selling days in the first month were wiped out by weather.
So securing 100 prescribers across 27 states while operating at half capacity due to a blizzard that speaks volumes about the resonance of their clinical data.
During the Q&A, Disbrow elaborated on why these early adopters were writing the scripts. The primary driver is patient inadequacy on current meds.
The doctors have a backlog of patients suffering from SSRI-induced sexual dysfunction or metabolic issues, and the promise of a clean 5-HT1A agonist is just too compelling to ignore.
And the early anecdotal feedback from patients on Exua centers heavily on strong tolerability, which validates the clinical trial data.
So the scripts are flowing, the doctors are adopting it, but the revenue won't materialize until June.
Right. So the existential question for Aytu is whether their balance sheet can survive the wait. Let's look at the financial runway.
The metrics Selhorn provided are incredibly transparent. Operating expenses are projected to tick up in the March quarter to roughly $4 million to $5 million, excluding D&A.
With $30 million in cash sitting on the balance sheet, a $5 million quarterly cash burn provides immense breathing room. They aren't staring down an immediate liquidity crisis.
No, they aren't. And Selhorn also provided a longer-term stabilization target. By the end of the fiscal year, Aytu is projecting an exit run rate of $11.6 million per quarter in total OPEX, with about $500,000 of that being non-cash.
So a stabilized cash burn of $11.1 million per quarter brings into focus the single most important metric for any growth stage biotech.
The break-even point.
The magic number. Management laid out the exact math required to start burning cash and turn profitable. Break-even sits at $17.3 million of net revenue per quarter.
And factoring out non-cash items, the pure cash breaking point is roughly $16.6 million in quarterly revenue.
To put that $16.6 million threshold in perspective, Aytu just generated $15.2 million in a transitional quarter, where they actively suppressed ADHD marketing and gave Exua away for free.
They only need to locate an additional $1.4 million in quarterly cash revenue to reach the break-in milestone.
And achieving that incremental revenue becomes highly probable when you examine the unit economics of Exua.
Right, because Aytu acquired the drug rather than developing it internally from scratch, so they are obligated to pay royalties.
Aytu pays a 28% royalty on Exua net sales.
And on top of the royalty, Aytu negotiates a true-up on the cost of goods sold with their manufacturing partners.
In pharma manufacturing, initial batches are often priced based on estimated yields. Once the production run is complete and the exact material and labor costs are known, a financial true-up occurs to reconcile the estimated costs with the actual cost.
So Selhorn combined the 28% royalty and the manufacturing COGS true-up into a single, easily digestible metric.
An effective 31% cost of goods sold.
Which yields a massive 69% gross contribution margin.
For every $100 of Exua sold, Aytu retains $69 to cover their operating expenses.
Once they cross that $16.6 million break-even threshold, the financial leverage is explosive. 69 cents of every incremental dollar flows directly to the bottom line as pure profit.
That intense leverage prompted a critical question during the earnings call Q&A from Thomas Flatten at Lake Street Capital.
He recognized the 69% margin and the 21 million patient TAM and asked management if they were tempted to accelerate.
He wanted to know if Aytu planned to hit the gas, raise external capital, and massively expand the sales force right now to capture market share faster.
And Disbrow's response is the ultimate proof of management's discipline.
Small-cap biotech CEOs are notoriously addicted to dilution. The moment the stock bumps on good clinical news, they issue secondary offerings, dilute the retail shareholders, and bloat their operational headcount.
But Disbrow firmly stated there is zero appetite to raise capital just to expand the sales force.
He acknowledged that their data analytics have identified highly lucrative territories beyond the 44 regions they currently staff.
But he was adamant that geographic expansion will be funded organically. They will only hire new reps when the internal cash flow generated by Exua justifies the expense.
They are prioritizing shareholder equity over reckless top-line vanity metrics.
Which is so rare in this space.
It really is. So let's pull all this together for Section 4. The bottom line, we've got them defending the ADHD portfolio with an authorized generic.
Utilizing the RxConnect moat to bypass PBM friction.
Slashing launch costs without sacrificing readiness, capping patient out-of-pocket costs to guarantee clinical trial periods,
and refusing to dilute the stock to fund premature expansion.
Pulling all of these strategic maneuvers together forms the foundation for our opinionated verdict. Are we bullish or bearish?
Looking past the headline accounting anomalies, we view Aytu's Q2 performance and strategic positioning as a cautious but highly asymmetrical bullish signal for the long-term patient investor.
The bull case is anchored by the fundamental reality of the asset. Aytu trades at microcap valuation multiples while possessing a highly differentiated FDA-approved therapeutic targeting a 21 million patient market.
Exua directly resolves the weight gain and sexual dysfunction side effects that force 50% of depressed patients to abandon traditional SSRI therapies.
Furthermore, their execution is battle-tested. The way they neutralized Teva's generic ANDA launch, retaining 95% of their branded prescription volume through the RxConnect infrastructure, proves management can navigate highly complex commercial threats.
Combined with a secure $30 million cash runway and a definitive path to break even, the downside risk is significantly mitigated.
However, and this is a big however, we must stress the cautious element of our bullish verdict.
Yeah, the primary risk facing retail investors over the next 3 to 6 months is the valley of death, created by the Exua launch mechanics.
Because Aytu is subsidizing the first 2 months of therapy to build physician confidence and patient loyalty, the upcoming March earnings report will almost certainly feature sluggish top-line revenue growth.
And the risk lies in how the broader market processes that sluggish revenue. Algorithmic trading models and institutional screeners do not read earnings transcripts.
They don't. They do not understand the nuance of the freemium strategy or the delayed monetization of monthly refills.
They simply scrape the headline revenue number, compare it to the consensus estimate, and trigger automated sell orders if it misses.
So this is your actionable takeaway for the deep dive. If you currently hold AYTU in your portfolio, you must mentally inoculate yourself against the upcoming March earnings print.
Do not panic sell your position when the headline revenue numbers look anemic.
You have to ignore the broken financial x-ray and navigate the murky waters. Track the prescription volume metrics instead.
If the number of doctors prescribing Exua and the total scripts dispensed are growing exponentially, the revenue is merely deferred, not lost.
Conversely, if you are considering initiating a position in Aytu or adding to an existing holding, the algorithmic punishment following a weak Q3 revenue print could create an exceptionally lucrative entry point.
The broader market may severely misprice the stock in May, right before the fully monetized month 3 refills hit the income statement in the June 2026 quarter.
You want to buy the inevitable June refills at a discount caused by the March free trials. The value of doing this kind of deep dive of understanding why an 8.2 million warrant liability caused the net loss, or how a 5-HT1A partial agonist functions biologically, is that it allows you to see the chess match Aytu's management is playing while the rest of the market is focused on checkers.
They have structured a business designed to survive the short-term launch friction and capitalize massively on the back-end unit economics.
And the ultimate success of that strategy hinges on one final, provocative dynamic that every investor needs to monitor on their own. We talk about how Aytu is absorbing the cost for the first 2 months, capping patient exposure at $50, deliberately bypassing the pharmacy benefit managers to guarantee access.
But what happens when month 3 arrives?
Exactly. When the 2-month subsidy ends, the prescription enters the standard insurance adjudication process. The PBMs will attempt to force the patient through step therapy, demanding they fail on a cheap, generic SSRI before authorizing coverage for Exua.
And here's the defining question. If a patient has suffered from clinical depression for years, experienced severe weight gain and sexual dysfunction on an SSRI, and has finally found remission and systemic relief on Exua for 60 days,
Are they going to quietly accept a denial letter from a PBM administrator?
will the clinical efficacy of Exua generate enough patient conviction to overcome the administrative friction of the insurance industry?
If the clinical data holds true in the real world, the PBMs are going to face an unprecedented wave of patient advocacy. You will see patients bombarding their doctors for prior authorization appeals, fighting their insurance providers, and demanding permanent coverage for the drug that finally gave them their life back.
Watch the patient retention rates when those month 3 refills hit.
If retention holds strong against the PBM pressure, the murky waters will clear permanently, revealing a highly profitable, deeply entrenched pharmaceutical asset. Thanks for joining us on this Talk Tickers Deep Dive, and we'll see you next time.